These days, as a sole practitioner, I understand that my clients value me primarily for my tax knowledge. That's just how it is. I remember reading Canada's Globe and Mail shortly after the amalgamation of the three legacy accounting bodies in 2014. The illustration for the story was a word cloud centered around taxation. For most Canadians, their accountant is the one who does their taxes. That's not nothing. It's a difficult and complex specialty that requires years of experience and dedication to learn. For a single individual taxpayer in Canada earning the median income, the total effective tax rate for income and sales taxes combined typically ranges from 18% to 25% of their gross income. And if you look at a Canadian paystub, the take-home is further reduced by mandatory payroll taxes. When you add these to income and sales taxes, a single Canadian earning the median income often sees a total diversion of 28% to 35% of their gross earnings toward taxes and mandatory social contributions. So taxation is not only complex, effective tax planning and compliance is vitally important to almost everyone.
The accounting services industry in Canada has expanded significantly in both economic output and strategic importance over the last 75 years. This growth reflects Canada's transition from a resource-based economy to a complex, service-oriented one. While the raw data for the 1950s is often bundled into broader categories, the trajectory since the mid-20th century shows a clear trend. Accounting has evolved from a back-office bookkeeping function into a critical driver of the professional, scientific, and technical services sector. When we initially formed the Small Business Analysts Society of Canada, we looked at the breakdown of revenue by service type. It was clear then that the breakdown of services was skewed because of the dominance of what Statistics Canada referred to as the, quote, 10 largest firms. According to their most recent 2024 report, the accounting, tax preparation, bookkeeping, and payroll services industry remained relatively concentrated in 2024, with the top 10 firms accounting for almost half, 45%, of total operating revenue. However, the Statistics Canada report on the industry obscures the dominance of the Big Four firms. Between them, the Big Four firms accounted for 39.25% of total industry revenue. The remaining six, i.e. 6 of the top 10 firms, accounted for less than 6% of industry revenue. Why does Statistics Canada not acknowledge the obvious outsized influence and importance of the Big Four firms? Interestingly, the classification of Big Four firms as a part of the accounting services industry is itself questionable. Every business in Canada is assigned a single North American industry classification system code based on its primary activity, the activity that generates the most value added or revenue. According to StatsCan's classification system, accounting services includes firms which primarily provide auditing, tax, or bookkeeping services. When this is the case, the entire firm's financial data, including its consulting revenue, is captured under the accounting services report. Consulting services includes firms which primarily provide advice on management, environmental, or scientific issues. However, there is an anomaly when it comes to the so-called Big Four. A Big Four firm is typically classified under accounting because its core identity and majority revenue traditionally stem from audit and tax, even if it has a massive consulting wing. So why do we classify Big Four accounting firms based on their so-called core identity? Is this because the Big Four have successfully lobbied for statutory exemptions from employment standards and other legislation, because of the historical importance of auditing, and the fact that, decades ago, new entrants were effectively, quote, apprenticed and trained in-house by CA firms? Does this still make sense today when assurance services are arguably much less important in a world where private equity is more important, and the size of Canadian employers has declined in a very meaningful way since the 1950s? Consider also that the greater part of their training costs have been outsourced to our universities and are paid for by governments and students themselves. Manufacturing's share of total employment fell from roughly 25 to 30% in the 1950s to 1970s to about 9% today. Looked at another way, it's pretty clear that the Big Four firms, based on their largest source of revenue, could arguably be included in the consulting services industry. In 2025, 2 of the Big Four earn the majority of their revenue from management consulting. In fact, their tax service revenue includes legal services, making their classification even more problematic. If we eliminate the results of the Big Four firms from the statistics for Canadian firms in the industry, management consulting, at just 4%, is largely irrelevant for the remainder of firms. 1 and 2 practitioner accounting firms made up about 78% of CPA firms, according to a 2019 benchmarking study by CPA Canada. At SBA Canada, it's clear that Canada's dominant micro-business sector values their local CPA firm almost exclusively for their tax knowledge. These local practitioners are required to perform a combination of ad hoc systems design, bookkeeping, and financial statement compilation before they can perform tax preparation and filing services on behalf of their small business clients. For almost all of these small accounting firms, these services are performed once a year in order to comply with tax filing requirements. They should, in our view, properly be considered part of a continuum of services ending in the filing of personal and corporate tax returns. Looked at this way, at least 95% of the work done by these small practices is made up of taxation and compilation services. We believe that this makes clear the difference between business models and expertise of our smallest firms, and those of the largest firms which increasingly control professional accounting regulatory bodies in Canada. Since the amalgamation of the three legacy accounting bodies in 2014, regulatory changes introduced by the newly merged profession have resulted in increased professional fees, primarily accounting fees, for micro-businesses that are currently more than double what their counterparts pay in the U.S. These increases were reported in a Canadian Federation of Independent Business study released in 2021. That same study found that government red tape actually declined in Canada between 2012 and 2020 compared to the U.S. While most professional bodies and conservative think tanks point to government red tape as the cause, our own research is that unfortunate business advice by Canada's lawyers and accountants has resulted in much higher rates of incorporation for micro-businesses in Canada, 2 to 4 times as likely as in other G7 countries. The rationale of limited liability by lawyers and tax deferral benefits by CPAs are often overblown, resulting in additional annual compliance costs of between $2,000 to $4,500 annually. We also have concerns about the relevance of audit services in the Canadian economy. Clearly, we have more than 3 times as many public companies per capita as any of the other G7 countries. But should we? The vast majority of such companies are listed on our venture exchanges, and most are unprofitable. The cost of being publicly listed is massive. At SBA Canada, we can't help but wonder if this is justified when we consider that acquisitions are usually much more likely and lucrative for entrepreneurs than IPOs, at least in Canada. The bulk of these massive fees represent a transfer from entrepreneurial firms to auditors, securities lawyers, and financial advisors. In our view, this situation is a symptom of the, quote, financialization of the Canadian economy. While we don't question the importance of auditing when it comes to senior exchanges with its many retail investors, private equity typically relies on deep knowledge of the firms being funded and acquired. They do their own due diligence before making an investment. In short, we don't view either management consulting, except tax advisory services, or audit and assurance services as particularly relevant or important for the real economy. Even the much-loved medium-sized business is a very rare creature anywhere in the G7. Between 95% and 99% of businesses within the G7 have 50 or fewer employees. A company with 50 employees does not even make the cut as a medium-sized business in Canada. Why do Canada's business schools, policymakers, and the business press place so much emphasis on these statistical rounding errors? At SBA Canada, we're focused on tax practitioners and their small business clients. We don't believe that CPA Canada serves the needs of either small professional accounting firms or their small business clients. In fact, the evidence shows that since amalgamation, there has been a massive transfer from small practitioners to large consolidator firms of roughly $2 billion. That corresponds to about $145,000 per practitioner in terms of the decline in the value of their firms on retirement. We believe that Canada's small professional tax practitioners and their small business clients deserve much better.